Hello, everyone. My name is Chris Young. I am Entravision Communications Chief Financial Officer. Thank you to the folks at Noble Capital Markets for inviting us to their 17th Annual Investor Conference. What I will do in this presentation is take everyone through, it'll last approximately 20 minutes, a pretty standard investor deck with some important changes that we've made to our operations over the past 12 to 18 months. And then I'll turn it over to Michael Kupinski, who will put together the questions coming from the audience. And with that said, I don't know if you're in listen-only mode or not, but I'm going to assume we are, and I'll just start with the presentation. So let's make the lawyers happy. I will be making forward-looking statements with respect to projections provided by Entravision. No reps or warranties with respect to the accuracy of those statements. With that said, let's continue. So let's start high level and then we'll dive into the details. Entravision Communication is a diversified global marketing, technology, and media company serving clients throughout the United States in more than 20 countries across Latin America, Europe, and Asia. We were founded in 1996. We went public in 2000. We have a little over 1,000 employees across, like I said, 22 countries. We trade on the New York Stock Exchange under the ticker EVC. High-level investment highlights, and then we'll get into the details from this page. But in a nutshell, solid financial position. We've got the best balance sheet, we believe, in the media business. Our net leverage is approximately 2 times when you factor in all of our cash, which was approximately $136 million at third quarter. We have strong free cash flow conversion. We have very little in the way of CapEx, and our interest rates are low, so that whatever we generate in EBITDA, a substantial portion of that ends up being converted to free cash flow. Our markets, we are in significant and growing markets for the U.S. I'll get into this in a little detail, but we serve the U.S. Latino community, a community which is growing and which approximates $1.9 trillion expected to be in 2023. We're also in less mature and growing global digital advertising markets across primarily Latin America. Forecasted to have a 13% CAGR between 2020 and 2023. Our core business, which is serving as Univision's largest TV affiliate group across the United States here, that's under one agreement that runs through the end of 2026. We have retransmission cash flow that adds to the stability of our overall free cash flow profile. We've got expanding platform of digital assets. Like I said, we've been working on diversifying a bit from our core television business. We've gotten into ad tech and marketing solution branding business, as well as performance and programmatic businesses. We've got a global footprint that provides extensive reach. Again, we are in 22 countries, 15 countries in Latin America specifically, and here in the United States, we are in 35 markets with local sales teams and assets. We've got a management team that's been around the block once or twice. Most of us at the senior level have been here for 15 years or longer, with the exception of Juan Saldivar, who's our newest digital addition, who heads our digital division, who's got extensive experience coming from Televisa and Bertelsmann. As far as our domestic operations are concerned, like I touched on, U.S. Latino market highlights, it's a $1.5 trillion market expected to top approximately 1.9 or 2 trillion by 2023. There were 59.9 million Latinos here in the United States in 2018. That is expected to grow to approximately 109 million in 2058. They are the largest U.S. ethnic or racial group here in the United States. 31% of the U.S. Hispanic population is under the age of 18 versus 20% among non-Hispanics. It's a very young demo, younger than the general population. The median age is 29 for males and 30 for females versus 37 and 39 respectively for males and females for the general population. And on the right side, you see the anticipated growth of the U.S. Latino population as far as percentage of the population and in whole numbers from 2018 to 2058. They're the pretty faces of the executive management team. Again, most of us have been here for 20 years or longer. The newest addition, like I said, is Juan Saldivar, who is our Chief Digital Strategy and Accountability Officer, who's been here for 6 years. He's also a board member. And he started out as a board member, got more and more involved with our digital efforts, and then it became, we all became aware of his skills and talents, and we brought him on board on a full-time basis to run our digital segment. And he's been a huge addition to this team. So let's go into some detail about our operating segments. We basically have 3 reporting segments. The first is television. We've got 55 television stations across the country. 21 markets. In 21 of those markets, we produce our own local news. We are by far and away Univision's largest affiliate group. We also are a Unimos affiliation. We have Unimos affiliations as well, which is owned by Univision. We've got 3 Fox stations across the country, as well as an NBC station in Palm Springs. For our audio group, we've got 48 terrestrial radio stations across the United States, in large part all Spanish language. We do have we have a couple that are English language, but yeah, we're predominantly one of the largest Spanish language radio broadcasters here in the country. And then as far as digital is concerned, we operate, again, in 22 countries. We've got programmatic branding and performance marketing platform and big tech sales partnerships, and I'll get into that with respect to our Cisneros acquisition a little later on down the road. Let's talk about an interesting data point for our TV segment. Like I said, we've got 55 stations across the country. We do produce local news, early and late newscasts in 21 of those markets. We reach 12 million households, which approximates 4.2 million weekly viewers. That's again across Univision, Unimos, Fox, the CW, and our NBC station in Palm Springs. As far as the landscape of Spanish language viewing is concerned here in the United States, the dominant player, no surprise to most, is Univision. A couple of Univision's 43.2% share of the marketplace of viewership. Add on top of that the 12.6% audience share it gets out of its wholly owned Unimos division, and that gets you to 56% of the Spanish language viewing across all of our markets. Telemundo is a number 2 against Univision's 43.2% at 40%. Telemundo is owned by NBC, which is in turn owned by Comcast. And then beyond Telemundo, beyond the 3 giants, you have Estrella TV as well as Azteca America. Other fact points about our TV segment and growth drivers. News consumption by Hispanics outpaces news consumption by non-Hispanics. Average weekly time spent per adult is actually 66% amongst Hispanics versus 47% amongst non-Hispanics. Where we do produce local news, we tend to be pretty good at it. We're number 1 or number 2, regardless of language. Again, that's an important fact to take in. In 10 of our markets, we've got year-over-year growth in 9 of our markets across the country. In late news, in 21 markets that we produce late news, we're number 1 or number 2, regardless of language, in 7 markets. As far as our radio or audio segment is concerned, we've got 48 stations across the country. Where we don't have physical stations in certain markets, we've got network affiliates where we are still broadcasting our content into third-party stations. We've got a footprint of 17 markets across the country. On day in, day out, our content reaches 96% of U.S. Hispanics across the country. We think we've got the best talent on Spanish language radio. We've got top brand name talent driving ratings. We've got network programming as well. On the right side of the slide, you see the cast of characters that we have that are driving our network and national ratings as far as our talent is concerned. We mentioned political. We had our third quarter earnings call the day or 2 days after the elections, and we felt it was prudent to at least disclose how we did in this most recent election cycle, since it was literally yesterday's news at that point. But we had a breakout year as far as the election was concerned. We think that validates the importance of the Latino vote in upcoming elections going forward. And we did approximately $28.2 million in political for 2020. And again, this was as of our third quarter earnings call, which was November 4th. There was no material political generated, obviously, after that. Actually, our call was on the 5th, not the 4th. But you compare that historically to what we've done going all the way back to 2006, and again, it was a breakout year. It was, I won't summarize the U.S. election other than to emphasize that the importance of the U.S. Latino vote had in the final decision-making process. And we've got the benefit of that as far as the ad spend is concerned. Let's talk about our digital segment. We think of our legacy digital segment in 4 sub-segments, I'll say. And the first is our U.S. local digital marketing solutions, where we really serve as more of a local agency of record for small and medium-sized businesses, running their social media advertising campaigns, giving them consulting on how to run a campaign effectively. It's more of like an agency business. We do have our own content that we monetize online, both our news content and our digital audio network content, which comes in the form of both streaming and podcasts. We've got a video and data segment as well in the form of scroller ads, as well as a data management platform called Data Expand, which is data that you use to enhance the effectiveness of your buy when you're buying online. We've also got a programmatic mobile performance engine in the form of a product called Cisneros, which is a proprietary programmatic buying platform, a DSP, that we've seen great success with over the past 3 years as that unit has grown significantly. We're pretty excited about that group. Where we would like to be going forward, with our Univision business notwithstanding, we've been focused on getting into markets where we anticipate significant growth. And no surprise to anybody, but this slide encapsulates where we expect that growth to be, which is basically in the global digital ad front, as well as the U.S. programmatic ad front, and then global app user spend. And these are segments of the digital marketplaces that we've been focused on as far as our M&A efforts are concerned. And with that said, let's talk about the most recent acquisition that we announced back on October 13th. This is a 51% acquisition of Cisneros Interactive. This platform is interesting in that it's a fairly simple business model. What these folks do is they handle the sales to large agencies in primarily Latin America, and the partners that they represent as far as sales reps are concerned are global brands such as Facebook, Spotify, and LinkedIn. This is an operation where Cisneros will basically inject themselves into the relationship. They will serve as the collections agent for these clients. They have quotas with Facebook and Spotify and LinkedIn. Should they hit those quotas, they get an extra couple of percentage points on the commission that they make off of these sales. They take the collections risk. These are clients that they have developed relationships over the decades with. So they're very familiar with their client base, and the big tech firms appreciate that that relationship to the point where they're willing to hand off that segment of the business, take the receivables risk in exchange for a fee that Cisneros takes. It's not a high margin business. It's approximately 5 to 6% on the margins, but needless to say that these tech firms are in marketplaces where the growth is explosive. And what we've seen to date since the acquisition has been, we've been very pleased with. And on the call, as of our third quarter call, we talked about revenue being approximately $55 million. This is contribution to fourth quarter from this acquisition, $55 million, and EBITDA of approximately $1 to $1.5 million. And that just represents our 51% share. We will gross the revenue. The revenue will show as gross. The EBITDA, however, will carve out the 49% that we don't own, and factoring that into our EBITDA calculation. Again, it's a business that we're very, very excited about. Beyond the 17 countries that they're currently operating in, we think that there's opportunities to expand in additional countries as well. And the Spotify and LinkedIn relationships are relatively new. They're just about a year old, whereas Facebook they've been working with for the better part of 3 years. Let's cover very briefly. Third quarter is fairly far back in the rearview mirror, but let's just cover the update. We did approximately $16.4 million in EBITDA in the third quarter, which if you compare to Q2, which is kind of a layup as far as the comp is concerned, it's explosive growth, but we all know that Q2 was really driven by the pandemic, and that was it kind of is what it is, right? And then against third quarter of last year, importantly, we achieved growth of approximately 80%, primarily being driven, let's be clear, on the political season that we enjoyed in the third quarter that spilled also into the fourth quarter. Let's talk about our balance sheet. As of third quarter, we had approximately $136 million in cash and marketable securities. Our debt is in the form of a Term Loan A product, $216 million outstanding as of third quarter. Our trailing 12-month consolidated adjusted EBITDA was $39.2 million. You factor in only $75 million of that $136 million of cash and marketable securities. In our credit agreement, that's as defined by our credit agreement, and you come up with a leverage per our credit agreement of 3.6 times. However, some investors just like to net the full cash balance against that debt to get a better picture of what that total net leverage looks like, and there you land right at 2 times, which we think is it's a nice position to be in relative to our competition and relative to what we're seeing in the local markets here as this economy struggles to break free of the pandemic-related issues. And then we talked about finally our pacing in the third quarter call for fourth quarter, and this is what the pacing discussion. This is how it laid out for digital, and again, digital is primarily being driven by the acquisition of Cisneros. This is not a pro forma digital number, but we're seeing digital revenues improve by approximately 250%. Television was up 46%, although we did indicate that core TV was back in the black, which was nice to see for the quarter. That's the first time we'd seen our television unit get back into positive pacing on a core basis, and we were pretty happy about that. And then radio pacing plus 15%, again, primarily driven by our political success. Radio was still slightly negative as far as the core business was concerned, but improving rapidly as we were getting deeper into the year. And we'll have an update for everybody on our fourth quarter call in the next, call it 4 to 5 weeks, I believe. So, and I believe that is it in the appendix for those who want to just check out a couple data slides in the back. We've got just a map of where we are and what we're doing in those markets, and then we've got some details as far as our local news is concerned and their rankings. So that's the core presentation that I have. With that, Michael, I'll turn it over to you.
Thanks, Chris. Yeah, just a couple of quick questions. And again, I just want to remind viewers to ask, if you want to ask a question, in the bottom right of your screen, there's a little icon, a bubble icon. Just press that, and then they'll come up with a screen where you can actually type in and send in a question directly to me. And I will review the questions and ask that, and I'll get it to as many of those as I possibly can. So while we kind of accumulate those questions, Chris, I have a couple.
Sure.
You know, what's really interesting is that the company has one of the lowest leveraged balance sheets in the industry, and you have one of the lowest multiples in the industry. Why do you think that people are not really, focused on Entravision?
Well, we've got one of the best balance sheets, but the lowest multiples as far as our trading activity. Look, we're a micro cap. We're, beyond your coverage, there are not many other sales size shops that are covering us, and that always hurts us as far as us trying to get our name out. We've hired a new investor relations firm to help me in our marketing efforts. But look, I think there's also the Spanish language element to our business model that people struggle to understand, not in its substance, but how we are potentially impacted by what's happening in the world. You've got two big events, obviously, the pandemic, which I've made reference to. All markets are struggling. I'm here in Los Angeles right now. I'm in the office, but, Los Angeles is pretty much the worst hit zone as I currently, give this presentation. And Los Angeles, quite frankly, is a huge operation for us. And, I think people are more focused in the short run on how we're being impacted by COVID, and then trying to figure out, what it means to come out of this recovery. We have done a lot of work in taking out significant expenses out of our business model in response to COVID. and I think that's been positively received. And I think as we take advantage, as we cycle through COVID, I think we're going to be in a great position to drive EBITDA and free cash flow as a result of the cuts that we've made. So perhaps we need to kind of bring the report card first before we start getting the benefit before we start to see the multiple come back to where perhaps it should be vis-a-vis our competition. There's also the aspect, the second big development for us is, the change in the current presidential administration, where I think it's safe to say you're certainly going to have a more user-friendly administration when it comes to immigration policy. And that has been a bit of a wet blanket over the past 4 years under the current administration in the bulk of our markets. Remember, you can go to that slide at the back and, to see where our markets are. We're predominantly located in the southwestern, markets of the United States, and we are the largest U.S.-Mexico border operator in the country. And those markets have been hard hit, not just by COVID like El Paso or Laredo, but also by immigration patterns. There used to be a ton of economic activity actually coming from Mexico into those local markets that has all but dried up. And our expectation is not necessarily overnight, but we expect to see those markets come back to some level of normalcy sometime in the next, call it 12 to 18 months, as we kind of cycle through the previous administration's policies as far as immigration is concerned. But I think those two issues are the big explanations for why you're seeing our multiple as depressed as it is.
Gotcha. And you mentioned about the TV pacings. Certainly there's a lot of noise around core, given the fact that there was such a huge amount of political, but a lot of broadcasters are indicating that core continues to perform pretty well going into the first quarter. Can you kind of give us a little color on what you're seeing there? As you mentioned, it's in the black.
Yeah, I would agree with that. The one factor that we're focused on is, TV is a big part of our ad pie for TV. I'm sorry, auto. Auto is a big segment of our ad pie. Right now it stands as the second largest advertising category for both TV and radio. And what we've been seeing is just a gradual comeback of automotive from kind of the nadir, call it, in the second quarter of this year. And I don't want to give too much color. It's still early as far as first quarter is concerned, but certainly TV has been the strongest segment to recover the fastest in response to this pandemic, and we expect that to continue into 2021.
And Chris, you've had some fits and starts with your radio business. Can you talk a little bit about your strategy? A couple of years ago was, hey, we got some great talent. We're going to, kind of invest here. And now it's a little bit of cost cutting. What is your strategy with radio at this point?
Well, I think the strategy with radio is fairly simple. We have re-engineered the radio business to the point, from a labor standpoint, that you're going to see significantly improved margins in our radio segment. And you're not going to need any kind of significant growth to achieve those margins. And whereas radio has been a de minimis contributor to our EBITDA generation as a company, I think with the cuts that we've made and our ability to maintain all of our talent, I think that short and sweet, that strategy is going to yield meaningful cash flow generation from the radio segment.
Great. And so I'm going to field some questions that are coming in now. Talk about Univision's ratings. They, we believe that they rebounded in 2019. Have your stations enjoyed a tailwind from that? And then also, if you could just talk a little bit about the merger of Univision recently completed. What changes have you seen there, or you expect to see in your relationship with Univision?
Sure. Short and to the point, Univision's ratings are up. They've been trending up for the past, we'll call it 18 months, and that trend continued and actually accelerated slightly into the pandemic because more people were home. We got a ratings benefit from that. So all of the problems, not all, but I'll say the majority of the issues that were holding Univision back as far as ratings were concerned. We think Televisa, who's the primary content producer of Univision content, has been reactive to those issues and has shortened the runtime of a novella. They've also made the stories a bit edgier in response to the competition, and it's yielding results. So we've been pleased with what we've seen as far as the ratings are concerned. What was the second part of your question? So the Univision. So yeah, so there's a new owner of Univision. That deal closed a couple of weeks ago. Wade Davis is now the new CEO of Univision. Look, it has zero impact on us. Univision's been public and private. They're still private, but there's no impact as far as our operations are concerned. We've had a couple of conversations with senior management over there. I'm in regular contact with senior management over there, and we're all looking to work together to to achieve the same thing, which is to continue to grow our respective performances and serve the Latino community here in the United States.
Okay, I have a long-winded question here, but I'm going to try to get this and summarize it as best I can. Can
Sure.
you discuss the growth pre-Cisneros that you expect in your digital business segment, and what type of margin are you targeting, since it's clear from recent commentary that margin in this segment is important to the company? And then let's stop there, and there's a second and third part to that question.
Sure. So the legacy digital before Cisneros, you're really talking about two components. You're talking about a U.S. domestic business. And that's a business where the growth expectation has generally been north of 10%, call it in the 15 to 20% range. It's been growing nicely, but the reality is it's from a materiality standpoint, it's not nearly as big as our international division. So an international division has had some execution issues. We did put new management in about a year ago. Smadex has had to be tweaked here and there in response to competition that has been, nipping at Smadex's heels as far as business is concerned. We think they've been responsive to those issues. On a margin basis, I'd put our U.S. digital business margin performance in kind of a 10% range, and our international business margin-wise kind of in the mid-single digits to high single digits range.
And then the second part to that, to this viewer's question is, within digital, what type of growth are you expecting from Smadex and its margin? And is there a path for Smadex to be partially monetized to kind of elevate this hidden value, given where other ad tech businesses have been trading in both the private and public market values?
So I think I know where that question's coming from. So one of the Smadex's primary competitors is a company called Liftoff. Liftoff is a larger operator than Smadex is, but they're both primarily in the same business. And Liftoff got a nice investment at a great multiple from, I believe it was Blackstone. Look, our Smadex business, when we acquired it, was doing approximately $3 million in revenue annually. Now the expectation is in the next 12 months, it'll do somewhere in the neighborhood of 30. That's a significant. That's significant growth over the past couple of years. Is there a chance of monetizing it separately? Look, there's always a chance, but it's not our focus right now. Our focus is just to continue to integrate Smadex with all of the other digital products that we have to offer. Continue to make Smadex a cutting-edge DSP, and continue to grow the. To grow that part of our business. And, from a monetization standpoint, I think I would agree with you, certainly, if you compare those Blackstone multiples to anything that Smadex could potentially trade at. Certainly, there's no value of that factored into our overall valuation. But with that said, you know what, we're going to focus on operating this thing and continuing to grow it, and we'll see what happens.
And Chris, obviously, you took a lot of cost out of the business in 2020, and I don't think that investors kind of recognize the amount of cost cuts that you've actually taken out, and especially as that might translate into 2021. Can you kind of give us a little bit more color about the cost reductions you have taken in 2020, how that might influence 2021, and especially given the fact that you're obviously going to be absent the $28.2 million in political revenues, which is very high margin. What are your thoughts about cash flow growth as we go into an off-election year?
Okay, so that's code for you want me to give you guidance for 2022, 21 rather. I'm not going to take that bait, but what I will say is, yes, we've got a $28 million, political hole revenue-wise and cash flow-wise to a certain extent to kind of make up for it. I think you'll see meaningful progress in a couple of segments that will look to offset that. First, you've got the Cisneros acquisition. Second, you're going to see meaningful contribution on a cash flow basis from our radio segment. And third, you're going to see meaningful contribution, we think, incrementally from the cost cuts that we've made permanent. And we've taken out approximately 20% of our labor force. We've reduced our labor force by effectively 20% year over year. And the majority of those reductions have been made permanent. So we think that, coupled with, obviously, against that 28 million, you're looking at a big juicy comp in the form of second quarter of last year, where we think we'll do significantly better than the 1.7 million of EBITDA that we produced last year in the middle of the pandemic. We certainly feel good about this year. We certainly think that a lot of ground is going to be made up of that $28 million in political by the issues that I just talked about, and we think there's potential for even more. So we're excited about 2021. That's the best way I can put it. We had a robust budget process. There was a lot of push and pull internally about what numbers should start looking like, and we've got a number that we feel we're all optimistic about, and I don't think everything that I see and everything that we see here internally, leads us to believe that we've made all the right decisions for 2021.
Gotcha. And Chris, there's obviously some properties on the market, whether or not you're going to look into the TV area. There's some TV stations on the market. If you're looking in radio, there appears to be some radio kind of loosening up in that marketplace. And of course, in the digital space, there's always properties, it looks like, that are available. Can you talk a little bit about your M&A strategy at this point? Where do you think that you're most likely to make acquisitions? Do you think it'd be television? Do you think it'd be in radio? Or do you think it'd be in digital? And then if you could just talk a little bit about the multiples and what is the type of acquisition that you're really looking at?
Sure. I think the next couple of acquisitions out there that you'll likely see us announcing, and again, nothing is imminent, but it will most likely be in the digital space, again, complementary to what we've been amassing over the past several years with an international flavor to it. And TV, certainly, TV needs to make sense to us. We're not that interested in English language TV, but certainly to the extent that there's a Spanish language opportunity, we'll take a look at. In radio, I just don't know, given what we're seeing out there in the marketplace with respect to Spanish language radio, I don't know if it's realistic to expect any meaningful M&A activity out of the radio industry. That's just me speculating, but it's been pretty quiet on that front.
And so another question. So the question is asking if you're involved with Univision's announced OTT service. And if not, how do you get protection, if any, on retransmission to the extent viewers cut the cord and move to their OTT offering?
So that's a conversation that we continue to have with Univision. We've not inked any deal per se yet, so that's an ongoing conversation that we expect to have. But as of right now, no, we are not involved in that streaming platform. And I should say they announced the streaming platform, but it's not actually functional yet. It's a landing page when you go to it. I don't know when the expectation is for that launch, but I would expect it to be relatively soon, and whether or not Entravision plays in it remains to be seen. To put it bluntly, if we're not involved with it and people decide to cut the cord, we'll lose a viewer. There's no protection on the downside to that scenario. We'd obviously like to be part of the streaming product that Univision's putting out there. We'd like to think that our local news is an important factor to local viewership, and whether we come to a deal with Univision or not remains to be seen. But, in the meantime, we'll continue to focus on our local efforts. We'll continue to focus on our digital efforts as well, and we'll see what happens with the OTT announcement over at Univision.
Are you a little bit at a disadvantage in negotiating with them on this point, Chris, because of your master affiliation agreement in any way?
Are we at a disadvantage because of our... Well, I mean, look,
for the retrans and
it's a supply and demand issue. So if they see the importance of local news into, in their streaming products, then I don't think we're at a disadvantage. If they see no value at all, then clearly we're at a disadvantage. So it's all on how you look at it. We like to think that the local news products that we do produce in our local markets does play a material role in their ratings performance. And if you believe in that, you buy in on that, you're going to want that product as part of their over-the-top streaming product. So we'll have to see.
How long does a master affiliation agreement go on for?
It runs to the end of 2026.
2026, okay.
Right.
Do you think that in the future, do you think that the company will try to negotiate its retransmission consent on its own instead of having Univision do that for you and then pay you a fee?
Sure, we'll have to wait and see, Michael. That comes into, we negotiate our retransmission agreements with our English language properties. We don't have that ability right now with Univision. We'll have to see how things play out with respect to the ebb and flow of the negotiations with respect to the, a potential new affiliation agreement with Univision. It's too early to speculate on that.
Gotcha. In terms of, as you kind of look at across the spectrum of ad trends, we talked a little bit about this, ex-political. Can you talk a little bit, you mentioned a little bit about auto. Some of the other broadcasters are saying that whereas audio was down as much as 68% in the second quarter, it was down about 8% in the fourth quarter. Can you just kind of give us your general trends of what you've seen in auto? Because it was such an important category. I think at one point it was, 32% of your broadcast advertising?
Yeah.
Where does auto stand?
Well, without giving too much detail for fourth quarter, we'll give that on our fourth quarter call. I'd say directionally speaking, we've been seeing the same thing. Clearly second quarter was the train wreck, and we've been seeing auto just gradually improve, week in, week out since the second quarter. We're not yet into positive territory yet, and I think that speaks to what you've heard as far as other markets or other competitors are concerned. But I think the expectation is we'll certainly get there at some point in 2021.
Gotcha. Chris, I'm not seeing any additional questions here, and I know you're pretty much on lockdown in California, so if you ever want to kind of get out and break away, come to Florida, it seems like nothing's happening here. It's everything's open.
So. Yeah, everything's open. It's amazing. I see the counts, the infections in Florida and California, and we've been wearing masks since March, and it seems like we're worse it than anybody, and I'm still trying to figure it out. I haven't seen a gym since March. Go figure. I may take you up on that, Michael.
All right, Chris. Well, thanks for participating in the conference, Chris. We greatly appreciate it. Thank you.
Thank you, Mike. I appreciate it. Have a great conference.